This video is to be used for educational purposes only and is not intended to replace individual research or licensed investment advice. Unique experiences and past performance does not guarantee future results. Trading stocks, options, and spot currencies involves substantial risk, and there's always the potential for loss. Your trading results may vary. No representations are being made that any software or training will guarantee profits or not result in losses from trading. This is the Premier Trade FOREX Report with Scott Norse.
Good afternoon, traders. I'm Scott Norse here with your FOREX Report. We are wrapping up the week on Friday, June 15th, 2007. It started as another terrific week for the U.S. dollar as the currency continued to make strides in the broad market. The most recent rally in the greenback began late last week on the back of rising Treasury yields and Wall Street's renewed confidence in a hawkish Fed. Giants such as Merrill Lynch and Goldman Sachs abandoned forecasts for rate cuts later this year, which gave bond yields and the dollar tremendous boosts. This carried forward into the first couple of trading days this week as we awaited a big lineup of U.S. data between Wednesday and today. Wednesday's retail sales came in very big, but failed to help the dollar run. While no breakdown of the data discredited the big jump, we can only assume that the stalling was technically driven. Thursday's hotter-than-expected PPI numbers also failed to fuel the dollar's rally, which is likely because of today's big lineup. The market sat very quietly last night as we headed into the string of U.S. reports to end the week. Dollar bulls were looking for a strong CPI number to help the buck continue higher, but didn't get what they needed. Yearly core CPI actually slipped to 2.2%, nudging closer to a level that the Fed is comfortable with. Despite a very big upside surprise in Empire Manufacturing and a narrower than expected current account deficit, traders simply were not convinced to buy the dollar. The rest of today's data was mixed, with tick data coming in very strong and industrial production posting no gain at all. Finally, U of M confidence came in disappointing and sparked the last bout of dollar weakness. The greenback will now end the week on a sour note, but is far from looking very bearish in the short term. Today's move really just solidifies our view that things are fairly neutral at the moment, with the dollar still underwater in the big picture. Now to this week's big picture. Last week we upped our expectations for the dollar through at least the remainder of the summer. We now see reason to believe the majors will find some broad ranges to trade in as U.S. data is showing signs of life and the Fed is no longer expected to cut, according to Fed funds futures. We are not shifting that outlook this week and remain fairly neutral overall. We are still looking for trades on the dollar, both long and short, while focusing on short-term opportunities. The greenback may be getting close to a near-term top, but that doesn't mean it won't find a little further strength in coming weeks. Traders will need fresh reasons to sell the U.S. currency to any great lengths against most of its counterparts. Another big picture item is the carry trade. It's something that needs to be addressed as well. Carry trades are directly linked to volatility and have an inverse relationship to volatility gauges. More than watching for the relationship between stock prices and the yen, we're now focusing on volatility indicators such as the VIX and implied volatility on currency options. While such numbers may not be readily available to some traders, we will keep an eye on these for potential turning signals on carry trades. Of course, volatility levels outside the bond market are low at present, which is promoting further selling of the Japanese yen. We'll keep you updated if we see a shift higher that may prompt some unwinding. Until next week, I hope you all enjoy your weekend. Take care.